Imagine a business whose entire job is to buy the scarcest, most expensive hardware on the planet, top-end NVIDIA GPUs, at a scale almost nobody else can manage, and rent it out to the world's biggest AI labs. Now imagine almost all of it is paid for with borrowed money. That's CoreWeave. I'm Onyx.
And I'm Nova. Welcome back to the Working Thesis. CoreWeave, ticker CRWV, might be the purest, highest-octane way to bet on the AI build-out, and also the clearest example of the financing risk underneath it. As always, this is a company explainer, not a recommendation. Let's understand what it is, and why smart people argue so hard about it.
First, a quick and honest word. Everything you're about to hear is really just the two of us thinking out loud, personal market commentary, made for learning and for fun. It isn't investment advice, and it isn't a recommendation.
And when we talk about a specific company, it's only ever to make a bigger idea click, never a nudge to buy or to sell. So take it as a starting point for your own curiosity. Do your own research and make the call that's right for you. Let's start with the jargon. CoreWeave calls itself a neocloud. A regular cloud, think the big general-purpose platforms, rents you all kinds of computing. A neocloud does one thing. It builds data centers packed with AI chips and rents that GPU power, tuned specifically for training and running AI models.
And the reason that's a business at all is scarcity. For the last few years, the best NVIDIA chips have been almost impossible to get in volume. CoreWeave's bet was to grab as many as humanly possible, as early as possible, and rent them to anyone racing to build AI. When the thing you own is scarce, you can charge a premium, and that's the whole engine. Quick snapshot. CoreWeave is based in Livingston, New Jersey, went public in March 2025, and has roughly 2,000 employees. The 2026 picture from our research desk is staggering for a company this young. Revenue guided to $12 to $13 billion this year, and a backlog contracted future revenue of about $99 billion as of March.
Market value is somewhere around $60 billion, but the enterprise value, which adds in the debt, is more like $90+ billion. Hold on to that gap between the two numbers, because that gap is the debt, and the debt is the entire story. And the origin story is almost too good. CoreWeave started in 2017 as a company called Atlantic Crypto. The founders were commodities and hedge fund traders, and they got into Ethereum mining, which back then ran on stacks of NVIDIA gaming GPUs. They became one of the biggest Ethereum miners in North America.
Then the 2018 crypto winter hit, mining profits collapsed, and they were sitting on a mountain of GPUs with nothing to do. So they pivoted, rent that hardware out for high-performance computing and, increasingly, AI. They rebranded as CoreWeave. An early partnership with an open-source AI group helped them learn the market. And then the AI boom of 2022 and 2023 turned their early GPU bet into gold.
NVIDIA made them a preferred partner with priority chip allocations. They undercut the big clouds on price, and in March 2025 they IPO'd, with NVIDIA itself stepping in as an anchor buyer. Within about 15 months they were in the Nasdaq 100, ex-crypto miners to AI infrastructure giant, in well under a decade. It's a remarkable run, and remarkable runs deserve scrutiny, not just applause.
So what's the product? Dense, performance-tuned clusters of NVIDIA GPUs, the H100S, H200S, and now the Blackwell generation, wired together with high-speed networking, storage, and orchestration software. They also bought weights and biases, a popular developer toolkit, to move up the stack closer to the people building models.
And the technical edge is real. Their data centers are purpose-built and liquid-cooled, running rack densities far beyond what older air-cooled sites can handle. They've posted leading results on industry AI benchmarks, and reportedly something like 8 of the top 10 model labs run on CoreWeave. A lot of their revenue comes through take-or-pay contracts. The customer commits to pay for the capacity whether they fully use it or not, which gives CoreWeave unusually visible locked-in revenue. Here's the nuance, and it's the crux of the whole debate. The moat is genuinely real. Priority access to scarce NVIDIA chips, deep know-how in running dense clusters, tight relationships with AI labs, long contracts, and a proven ability to deploy faster than the lumbering big clouds.
But the same moat is fragile. The hyperscalers can build their own capacity and stop renting. NVIDIA could reallocate chips elsewhere. GPUs lose value fast. A A new generation roughly every 18 to 24 months can knock 50% off the resale value of the last one, which is brutal when those chips are also your loan collateral. And customers stay multi-cloud, so there's not much software lock-in. We're faster is a great edge, right up until the big clouds catch up. On leadership, the co-founders, Michael and Trader as CEO, Brian Venturo, Brandon McBee, came from that trading desk world, and their real superpower turns out to be capital formation. They've raised and arranged tens of billions and locked up NVIDIA supply faster than anyone. That financial aggressiveness is a feature and a risk.
A couple of governance things worth flagging neutrally. There's a dual-class share structure which concentrates voting control with the founders, common for hot tech IPOs but worth knowing. And NVIDIA holds a stake and made a roughly $2 billion investment. Which brings us to the part of the story everyone argues about. Let's talk about the money, because this is the heart of it. CoreWeave is one of the most leveraged businesses in public tech. Depending on the source, it carries somewhere in the tens of billions of dollars of debt, and the interest bill is enormous. Interest expense was over $500 million in a single quarter, on track for well over $2 billion a year.
A lot of that borrowing is a special kind, GPU-backed loans. The chips themselves are the collateral, like a mortgage, but on graphics processors. They often use what's called a delayed draw term loan, where you only pull the money down as you actually deploy capacity, which keeps interest costs matched to the build. It's clever financial engineering. It also means growth depends on continuous access to fresh debt and equity. The capital markets have to stay open, or the whole machine slows. Now the controversy. NVIDIA sells GPUs to CoreWeave, invests equity in CoreWeave, and has been involved on the financing side too. So critics describe a loop. NVIDIA's money helps CoreWeave buy more NVIDIA chips, which supports NVIDIA's own demand. Some bears use much harsher language than that.
And to be fair, we should hold this carefully. It's a critique and a structural observation, not a proven verdict. Plenty of supplier-investor relationships exist in tech. But it does mean two of the AI era's biggest stories, NVIDIA and CoreWeave, are financially intertwined, so if AI demand ever wobbles, they could wobble together. That's the thing to understand, not a prediction. Competitively, the most interesting players are the hyperscalers, the giant clouds, because they're simultaneously CoreWeave's alternatives, its partial customers, and its self-building rivals. Microsoft has been CoreWeave's biggest customer, and is also perfectly capable of building its own clusters. That's the strange dance.
The core dynamic is build versus rent. The hyperscalers build their own campuses, but they rent from specialists like CoreWeave when GPU supply is tight, power is scarce, or they need capacity now. Then there's a pack of other neoclouds, Lambda, Nebius, Crusoe, and more, chasing the same workloads. CoreWeave is the scaled leader among the pure plays, but it's far smaller and far more leveraged than the hyperscalers it competes with. Which brings us to customer concentration, historically the big knock on CoreWeave. At one point, Microsoft was around 60% of revenue. One customer, more than half the business. The top two were over 3/4.
It's gotten better. There's now a direct OpenAI deal, a roughly $21 billion commitment from Meta signed in 2026, an Anthropic agreement, and the company says 10 customers are each committed to $1 billion or more. So it's diversifying. But it's still a handful of AI labs and hyperscalers. And crucially, their spending plans and their credit are what ultimately drive CoreWeave's fortunes. CoreWeave is, in a sense, a leveraged bet on its customers' leveraged bets. The growth itself is just enormous. Revenue more than doubling year over year, that $99 billion backlog, and management guiding that a chunk of it converts to revenue within a couple of years and most within 4. AI spending overall is still growing fast, and CoreWeave is riding the very front of that wave.
The binding constraint, interestingly, isn't demand, it's power. CoreWeave talks about having more than a gigawatt of capacity active and targeting many times that by 2030. That echoes a theme across the whole AI build. At some point the question stops being, can you get the chips, and becomes, can you get the electricity? But that backlog conversion is the key assumption, and it's unprovable until it actually happens. Let's lay out the risks plainly. 1. The debt. Huge balance, huge interest, and a model that needs constant financing. 2. Customer concentration, better, but still a few big names. 3. GPU obsolescence eating into collateral and rental rates faster than the accounting assumes.
4. That's circular financing entanglement with NVIDIA. 5. And this one's underrated, rate sensitivity. With floating rate debt and constant refinancing, a higher long-term interest rate directly pressures the stock. It genuinely trades a bit like a long-duration bond with a turbocharger. And 6. It's already had violent drawdowns, down something like 40% from its high at one point. This is not a quiet stock. On valuation, the normal tools barely work. There's no meaningful price to earnings because it's losing money on a GAAP basis. People look at enterprise value against sales, roughly 7 to 8 times forward, or enterprise value against that backlog, which is under 1 times.
And less than 1 times backlog sounds cheap. You're paying less than the contracted future revenue. But backlog is a promise, not cash in the bank. It only becomes valuable if it converts profitably and the financing stays open. Contrast that with the hyperscalers, which have positive free cash flow, diversified revenue, their own chips, and fortress balance sheets. CoreWeave earns its premium only if the future plays out close to the script. It's priced as a scarce AI infrastructure platform, which it is, but with a level of financial risk those giants simply don't carry. So the 2 cases, head-to-head. The bull, this is the leading pure-play AI cloud, with scarce NVIDIA supply, benchmark-leading performance, gigawatts of power, $100 billion backlog, and the top AI labs as customers. If that backlog converts as guided, today's losses are just the cost of building ahead of demand.
The bear, it's a highly leveraged GPU financing machine exposed to customer concentration, interest rates, chip depreciation, and NVIDIA dependency, and if AI demand pauses, or the hyperscalers pull capacity in-house, or rental prices fall, the debt and capex could overwhelm the equity despite that gorgeous backlog. What makes CoreWeave fascinating is that both cases are genuinely strong. That's exactly why it's so volatile. If you're tracking the story, watch 4 things: backlog actually converting to revenue on schedule, customer concentration keeping its downward trend, the interest bill and any new financing terms, and the direction of long-term rates, since this stock feels them directly.
And the bottom line, CoreWeave is the marquee way to own AI compute, and simultaneously the cleanest illustration of the financing risk underneath the whole AI build. It's a brilliant, fast-executing company sitting on a mountain of debt, whose value swings with rates and sentiment. The bull and bear cases are both legitimately strong, which is the most honest thing we can say about it. This has been an educational deep dive, not investment advice. Thanks for hanging out with us, and we'll see you next time. And that's where we'll leave it for today. Thank you, genuinely, for spending part of your day thinking this through with us.
The whole idea of this show is pretty simple. We hold a handful of theses about the world, and we test them out loud, together, a little more each day. No crystal balls, just curiosity and a willingness to be wrong.
So if that's your kind of thing, stick around for the next one, and tell us where we're getting it wrong. Honestly, the pushback is our favorite part.
Until next time, take care of yourself and keep asking good questions.